We're continuing on our study, The Truth About Personal Finance, what the Bible and historic academic research say is the best path to God-honoring financial independence. Our guiding verses for this study are Job 22:21. Submit to God and be at peace with Him. In this way, prosperity will come to you. In Hebrews 11:1, faith is being sure of what you hope for and certain of what you do not see. In Deuteronomy 8:17 through 18, you may say to yourself, my power and the strength of my hands have produced this wealth for me. But remember the Lord your God, for it is He who gives you the ability to produce wealth. And finally, from Job 21:16, but their prosperity is not in their own hands. Our study today is on taxes in your finances. We read from Mark 12:14 through 17, Matthew 22:17 through 21, or Luke 20:21 through 25. They came to him, Jesus, and said, Teacher, we know you are a man of integrity. You aren't swayed by others because you pay no attention to who they are, but you teach the way of God in accordance with the truth. Is it right to pay the imperial tax to Caesar or not? Bring me a denarius and let me look at it. They brought the coin, and he asked them, Whose portrait is this? They replied, Caesar's. Then Jesus said to them, Give to Caesar what is Caesar's, and to God what is God's. A disclaimer. Please do not consider any of the following information to be investment or tax advice. You must do your own due diligence and consult an investment professional like a certified financial planner and or a CPA, certified public accountant, for up-to-date tax advice. William Jane Bernstein writes, the key is, what is the tax structure of your portfolio? Many professionals have most of their portfolios in 401k, IRA, KEHO, and pension accounts. This gives them the freedom to invest in almost any asset class they desire without regard to tax consequences. While Kathleen Coxwell reports the importance of minimizing taxes when she writes, yes, you'll still have to pay taxes in retirement. The average American family pays about $10,500 a year in total income taxes, including federal, state, and local taxes. $10,000 can be a big chunk of change, being about 14% of the average retirement budget. Tax planning should be a big part of your retirement plan. Forethought can help you retain much more of your hard-earned money. When studied, it was found that a typical couple in retirement, the effective tax rate fluctuated dramatically between 0 and 23.8%. And there was no single number you could choose to give the correct answer over an entire retirement. Even more alarming is that estimates suggest that for each 1% error in the effective tax rate, you introduce an 8% error in your final retirement savings balance. William J. Bernstein writes, tax efficiency is an extremely important concept to understand. It is a measure of the percent of the fund's return you receive after the taxes on the distributions are paid. A stock fund with no turnover, example index fund, will produce no capital gains distributions. You will be taxed only on the relatively small amount of stock dividends the fund passes through to you. Such a fund is highly tax efficient. On the other hand, an actively managed stock fund with high turnover will periodically distribute a large amount of capital gains to you, on which taxes must be paid. Such a fund is tax inefficient. Worst of all are REITs and junk bond funds, which distribute almost all the rate of return in the form of dividends. Further, the dividends are taxed at the high ordinary income tax rate. Obviously, then, you will want to hold only tax-efficient funds in your taxable account, reserving the most tax-inefficient ones for your retirement tax-sheltered accounts. Since tax-efficient equity stock funds provide excellent deferral of taxation, the all-taxable investor will want a high portion of stocks than the all-sheltered investor, all other things being equal. Why you should pay your taxes. God's word says in Romans 13:1 that everyone must submit himself to the governing authorities, for there is no authority except for that which is established by God. The authorities that exist have been established by God. God established it as our duty as citizens to pay our taxes. Jesus says in Matthew 21:21, "Give to Caesar, the government, what is Caesar's, and to God what is God's." In Romans 13:6-7, it states, "This is why you pay taxes, for the authorities are God's servants, who give their full time to governing. Give everyone what you owe him. If you owe taxes, pay taxes. If revenue, then revenue. If respect, then respect. If honor, then honor." This does not mean we need to pay more than our fair share of taxes. In Luke 3:13, John the Baptizer said to the tax collectors, "Don't collect any more than you are required to." We may minimize our taxes by using any wise methods that are legally and spiritually permissible. Tax advantage or tax sheltered savings. It is wise to use tax advantage savings for our retirement savings, whether a 401k, 403b, traditional IRA, or Roth 401k, or Roth IRA. These are all tax advantage savings programs authorized by the government that will reduce your taxes in the present or in the future. Andrew Tobias writes, "The basic difference between the Roth IRA and the traditional IRA is that with the traditional one, you get your tax break on the way in. Contributions are made pre-tax. Whereas with the Roth IRA, you get your break on the way out. Contributions are made with after-tax money, and your earnings and withdrawals are tax-free. The same is true when considering the 401k or 403b. The money goes in the investment account pre-tax, and this money is taxed upon withdrawal and is subject to required minimum distributions. That is after the age 73 currently and will rise to 75 in the future. With a Roth 401k, the money is invested after taxes, is not taxed upon withdrawal, although is subject to RMDs. Tax advantage or tax sheltered savings. Andrew Tobias writes, "If you want to retire in comfort, we will have to provide in large measure plus Social Security for ourselves. Fortunately, there are a variety of tax-deferred retirement plans to help. The best retirement plans are the 401k and 403b salary reduction plans. What makes them so good is that many employers add 25 cents or 50 cents or even more to each dollar you choose to save this way. This is free money. You should fund your 401k because it is a relatively painless way to save. You avoid taxes on the money you contribute until many years later when you withdraw it. In the meantime, no taxes due as it grows. Kathleen Coxwell writes, "The Roth IRA is popular because your money grows tax-free. Withdrawals are not taxed, and you are not required to make minimum distributions or take minimum distributions, or RMDs. In 2024, you can only save into a Roth IRA if your modified adjusted gross income is $161,000 or less as a single filer and $240,000 or less as a married couple filing jointly. Tax-free growth is the name of the Roth IRA game. So invest for growth appropriate for your age, time horizon, and risk tolerance. Don't overlook the opportunity for your spouse to save. If your spouse has earned income, make sure they are saving in the most advantageous vehicle possible, which may very well be a Roth IRA account. Even if your spouse does not have earned income, you can max out a Roth IRA by using a spousal IRA. No financial decision should ever be made without understanding the pros and cons in terms of both your current and future overall financial picture. Investors in an IRA or 401k account need not burden their minds nor their checkbooks with tax consequences or issues. As taxes are deferred, returns rise significantly with each additional year that an investor elects to hold fund shares. The Jeffrey Company says, taxable investing is a loser's game. Those who lose the least, taxes and fees, stand to win the most when the game is over. To put it simply, a tax that is deferred is the functional equivalent of an interest-free loan from the U.S. Treasury Department with a maturity equal to the number of years of deferral. What the Bible says regarding taxes, we read from Genesis 47:24 through 25. But when the crop comes in, give a fifth of it to Pharaoh. The other 4/5 you may keep as seed for the fields and as food for yourselves and your households and your children. And in 2 Kings 23:35, he taxed the land and exacted the silver and gold from the people of the land according to their assessments. And that's from 2 Kings 23:25. Taxes were here from the beginning of time and will be here until Christ comes. Do not use actively managed funds in taxable accounts. Actively managed mutual funds routinely ignore taxes by engaging in rapid-fire portfolio turnover, which generates excessive taxes for investors using taxable accounts. The dichotomy is that a portfolio manager's performance is measured and applauded on the basis of pre-tax returns. Few portfolio managers spend their time agonizing over the tax consequences of their decisions. Transaction costs are considerably more in international markets. Thus, the annual handicap to be overcome by active managers approaches 4%, nearly double the 2+% handicap faced by U.S. equity managers. a much-needed prospectus of full disclosure of actively managed mutual funds should read, "This fund is managed without regard to tax considerations, and given its expected rate of portfolio turnover, is likely to realize and distribute a high portion of its capital returns in the form of capital gains that are taxable distributions annually, a substantial portion of which are likely to be realized in the form of short-term gains subject to full income rates." Index mutual funds are tax efficient. The index fund is the odds-on favorite to outpace 3 of every 4 mutual fund managers. An investor's goal is not simply to minimize the tax burden, but rather to achieve the highest possible net return. The annual portfolio turnover of an all-market index fund rarely exceeds 2 to 3%, essentially for an average holder period of 33 to 50 years. That long time horizon is surely a significant factor in the formidable relative pre-tax returns savings of index funds have provided, as well as in their almost unparalleled superiority in providing after-tax returns. The bottom line is index mutual funds are tax efficient. We suggest that the best solution to this problem in taxable accounts is to use low-cost, low-turnover, tax-efficient index funds that do not depend on the skill, luck, or stock-picking managers. They are tax-efficient and low-cost, reflect their benchmark index, and can be held indefinitely. The lower tax rates or qualified dividends increase the tax efficiency of holding stocks to bonds in taxable accounts, whose yield is taxed at ordinary income rates. We generally recommend placing stocks in taxable accounts and bonds in tax advantage accounts. Buy and hold to avoid short-term capital gains taxes. A short-term capital gain is a profit on the sale of a security or mutual fund share that is held for 12 months or less. A long-term capital gain is a profit on the sale of a security or mutual fund share that is held for more than 1 year. One of the easiest and most important and effective ways to cut mutual fund taxes significantly is to hold mutual funds for more than 12 months. Buy and hold is a very effective strategy for taxable accounts. Investments and their tax efficiency. For maximum tax efficiency in taxable accounts, you should do the following. 1, favor funds with low dividends. 2, favor funds with qualified dividends. 3, favor funds with low turnover. And 4, favor tax-efficient index funds and tax-managed funds. Relative tax efficiency rankings. The relative tax efficiency rankings for major asset classes from the most tax efficient to least tax efficient is: number 1, low yielding cash or money market funds. Second most efficient, tax managed stock funds. Third, total market stock index funds. Fourth, mid-cap and small-cap index funds. 5, active stock funds. 6, balanced funds. 7, taxable bond funds. 8, REIT funds. And 9, high-yield or junk bond funds. A good source for locating a fund's tax efficiency rating is www.morningstar.com. Morningstar provides a tax cost ratio, which is the actual percentage point reduction in return resulting from taxes for an investor in the maximum federal tax bracket. Use the ratio from the longest period so that both bull and bear markets are included. Portfolio tax management. Tax manage your portfolio by 1, keeping your turnover low, buy funds and hold forever. 2, use only tax-efficient funds in taxable accounts. 3, avoid short-term capital gains. Hold profitable shares longer than 12 months. 4, buy fund shares after the distribution date. 5, sell fund shares before the distribution date. 6, sell profitable shares after the new year. 7, harvest tax losses to reduce current and future income taxes. Maxing out your tax advantage savings accounts prior to taxable account investment. Ben Carlson writes, anyone starting out saving should have as much of their long-term capital as possible in tax-sheltered accounts. This is a no-brainer for those funds you won't need to touch for many decades. Bonds, REITs, high dividend paying stocks, and pretty much anything with regular income payments besides tax-free municipal bonds should go in tax-deferred retirement accounts because they are tax-inefficient assets. You can max out your elective deferral contributions to 401k, 403b, 457, and thrift savings plans up to $23,500 per year. If you are 50, you can use a catch-up contribution of $7,500 for total savings of up to $31,000 per year. This is effective of 2025. The contribution limit for traditional and Roth IRAs is $7,000, with a catch-up contribution of an additional $10,000 for a total of $8,000 for those 50 and older. Deductions that save on your taxes. Know that if you're 65 or older, you have a higher standard deduction. This deduction for singles in 2024 is $15,700. For married filing jointly with both over 65, $30,700. And from head of household, $22,650. You can put money into a health savings account, HSA, to increase your tax deductions as long as a high deductible health plan is appropriate medical insurance for you and your family. Money put in a high deductible savings account is deductible up to $4,150 for individuals and $8,300 for families in 2024, plus an additional $1,000 if you are over age 55. Distributions from an HSA are also tax-free when they are used for medical expenses. The interest you pay on home mortgages and points paid at closing are tax deductible if you itemize. So is the interest you pay on student loans when you itemize. Deductions that save on your taxes. Consider bundling medical deductions into certain tax years. You can only deduct medical expenses which exceed 7.5% of your 2024 adjusted gross income. If you already had some significant healthcare expenses for the year, see if you can move medical, dental expenses that you'd normally take early the next year to the end of this one. Long-term care insurance premiums for long-term care insurance are deductible with the amount of deduction determined by your age. These deductions in 2025 can range from $1,800 for those 50 to 59, $4,810 for those 60 to 69, and $6,020 if you're 70 or older. Tax savings through charitable contributions. Kathleen Coxwell writes, charitable contributions of up to 60% of your adjusted gross income are also deductible if you itemize and give it to a qualified charity. Instead of making annual charitable gifts, give 2, 3, 4, or even 5 years worth of donations in a single year, then take a few years off. You can carry forward cash charitable giving above annual deduction limits for up to 5 years. Normally, you can deduct up to 60% of your adjusted gross income of cash donations, and appreciated securities are limited to 30% of adjusted gross income. Donor advised fund. A donor advised fund may be an option if you are bundling charitable expenses. A donor advised fund is a private fund administered by a third party and created for the purpose of managing charitable donations on behalf of an organization, family, or individual. Per Fidelity Investments, a DAF may allow for tax-deductible contributions of cash or appreciated assets in a given year, but then control the timing of the distributions to charity in future years. Jessica McBride writes, gift appreciated securities such as mutual funds, ETFs, or individual stocks to minimize future capital gains. While Taylor Turner writes, you won't owe capital gains tax on the donated asset. You'll still receive a charitable donation, and you'll meet your giving goals, possibly having paid less out of pocket. Qualified charitable distributions. Donate up to $100,000 annually from your IRA directly to a qualified charity through a qualified charitable distribution, as long as you're at least 73 when making the gift, and the check is payable directly to the qualified charity. Then the distribution should not be taxable income, but should satisfy at least a portion of your yearly RMD. Leave a bequest to charity. Taylor Turner writes, naming a charity as a beneficiary or leaving a bequest in your will or trust allows you to give to causes that are meaningful to you without possibly overextending yourself. You don't want to run out of money in retirement due to longevity of life or the need to spend more for long-term care or health care in your future. Retiring early, know your withdrawal options. Kathleen Coxwell outlines legal provisions in the tax laws that allow early withdrawal from tax advantage accounts without penalty. She writes, traditional retirement savings vehicles like 401ks and IRAs enforce a 10% early withdrawal penalty made before age 59 and a half. However, there are a couple of ways around the rules. You may want to learn more about the 72T and Rule of 55 provisions, ways to make penalty-free withdrawals from your retirement accounts before you return 59 and a half. Kathleen Coxwell also writes there are downsides to penalty-free withdrawals, including no penalty, but you do need to pay applicable taxes. 2, if the money is spent, it's no longer growing. You not only want to think about the money you are spending, but also the potential growth on the money that you are losing. 3, you increase your risk of running out of money in retirement. 4, the withdrawal strategies are complicated and you don't want to get them wrong and end up paying the 10% penalty. What order should you withdraw funds for retirement? Kathleen Coxwell writes, conventional wisdom holds that you should start by drawing on the taxable account assets and then next move to the tax-deferred accounts, saving the Roth accounts, which are tax-free, for last as for passing on a legacy. However, you want to remain flexible. It may not necessarily be advantageous to strictly follow the above guidelines, and it is in fact ideal to keep assets in each type of account to be able to tap into them throughout your lifetime. This allows for additional flexibility to both help lower your overall tax burden and also spread taxes out over time so you don't have to pay them all at once. Patrick Villanova recently reported that a Fidelity study found that you can reduce your retirement lifetime total tax bill by taking a proportional percentage withdrawal from all types of retirement accounts. If you are in a low tax bracket, taking capital gains from your investments may be a good idea. Consider if you now may be a good time to sell stocks that have appreciated significantly in value. This can be a particularly good strategy if you were in the 10 to 12% federal tax brackets, since your capital gains tax may be 0. Strategize for Roth IRA conversions. Kathleen Coxwell writes, you can pay taxes now, but avoid paying taxes on your gains if you save in a Roth IRA account. Roth IRAs do not have required minimum distributions, although Roth 401ks do. Should you do a Roth IRA conversion from your IRA? Knowing when to do a conversion can be confusing. Consider a Roth conversion if these situations apply and if you have the cash on hand to pay the taxes. The first situation is you anticipate a higher future tax rate. Number 2, you're hoping to leave money to heirs since they won't have to pay taxes on the Roth IRA funds. 3, you expect future returns to be higher because the market has fallen. If you do a Roth conversion before you see the big gains, then you will be paying taxes on a lower dollar amount and all of the growth will be tax-free. Withdrawals are a long way off. Number 4. Number 5, you don't need the money from RMDs, your required minimum distributions. 6, you anticipate an income in the future above the allowable for contributions. 7, the tax rate of return you anticipate making on the Roth IRA funds. And 8, the amount of money in traditional IRAs and the value of RMD when you are 73. Tax loss harvesting. Tax loss harvesting allows you to get rid of your loser investments while profiting a little from the transaction. You are only taxed on net capital gains, the amount you gained minus any investment losses. So any realized losses can help lower your tax bill. Therefore, if you know you're going to have realized gains, it may make sense to look for opportunities to realize losses to offset them. If you have shares of funds or stocks that have lost value since you purchased them, you may want to consider selling them. In fact, if you have more losses than gains, you can use the extra losses to erase up to $3,000 of ordinary taxable income, including the RMDs from your traditional IRAs, on your federal income taxes. You can also carry forward losses to future tax years. Be aware of the wash sale rule, which says you can't buy a similar fund or security within 30 days before or after a tax loss harvest for 30 days. Conclusion. Tax planning should be a big part of your retirement plan. Forethought can help you retain much more of your hard-earned money. Consult with your CPA or CFP to help implement the best tax saving strategy for your unique situation. A stock index mutual fund is the wisest choice for taxable accounts, as it is very tax efficient. Keep actively managed stock mutual funds, bonds, high dividend paying stocks, REITs, and junk bond or high yield funds in tax sheltered accounts. Always max out your tax sheltered savings prior to placing investment in taxable accounts. Buy and hold your stock mutual fund investments for at least 1 year to avoid short-term capital gains taxes. Use all legal tax deductions and credits on your taxes. Action steps. Have you been considering the tax consequences of your investment portfolio? If not, examine how you have distributed assets between taxable and tax-sheltered accounts. Use only tax-sheltered accounts for your investments until you have maxed out your contributions to these accounts. Action step number 2. If you have taxable investments you are using tax-efficient index funds in these accounts, are you using efficient assets? If not, consider making a change to the tax-efficient low-cost index fund. Number 3, are you using Roth IRA contributions to decrease any tax consequences of leaving a legacy to your children and or to lower your taxes in retirement? If you have a long time horizon and or are in a lower income tax bracket, this may be an ideal time to invest in a Roth IRA.